second speaker is Kristen Sullivan. Kristen is a partner at Deloitte Touche's Sustainability and KPI Services, working with clients to help address their sustainability and non-financial disclosure strategy needs. Good morning. Good morning, Kristen.
Hi, good morning. Thank you so much, Paul, and thank you, Peter. It's great to be with you all today in a virtual setting, and I'm always thrilled to be a part of this conversation. And great to hear Katie's remarks just prior to me. I think I'm going to just zoom out a little bit and speak a little bit to what's happening on the ESG landscape just broadly as we think about how sustainable finance is rapidly accelerating and some of the conditions that are necessary to be in place to really unlock capital at scale and really reward those organizations who are truly integrating ESG considerations from both a risk as well as an opportunity standpoint. And I know that reporting is not always the sexiest of topics, but I would say that even in just the last couple of weeks, there have been unprecedented developments in the overall ESG landscape that I think anyone will be excited about in terms of really putting that emphasis on the importance of transparent, high quality, relevant and reliable ESG information from a data exchange to really inform decision-making among all market participants. So maybe I just step back and speak just broadly from a market perspective. I think clearly this is a very sophisticated audience, but we think about entering 2020 with the level of energy that we saw coming out of the BlackRock Larry Fink, Dear CEO letter, the attention by State Street and other large institutions, the attention at Davos around just this concept of, whether it was the theme of the fundamental reshaping of finance or just this emphasis on the need for more consistent, high quality and meaningful ESG disclosure to drive efficiency in the capital markets and recognizing that we have large systemic risks that are facing the capital markets. Clearly pre-COVID, we saw with the World Economic Forum's annual risk report that the top 5 of risks to the global economy, both in terms of impact and likelihood, were environmental in nature. And I think just to touch on some of the points that Peter made in the introduction, somewhat under the radar, you might argue, was infectious disease in terms of top 10 in terms of impact to the economy, but the global economy was really nowhere on the radar in terms of likelihood. And so I think what certainly happened is this sort of radical recalibration of risk within organizations and really rethinking the way enterprise risk is organized and the time horizons that are used and the ability to access information to really think about those risks and disruptors from an environmental and societal standpoint that companies need to be better equipped for. And we've seen the capital markets really reward those companies who were high ESG performers with the ESG fund outperformance in the first couple of quarters of the year. I think that just to further emphasize on the investor attention that we saw and very much this emphasis on not just more information, more ESG disclosure that investors are looking for, but more standardized disclosure. And we saw for the first time sort of a declaration that there are specific standards that investors are looking for companies to follow. And that's all in the spirit of, absent effective disclosure, decision useful disclosure, that the markets aren't able to effectively price risk. And so we started to see this momentum around standards really start to mobilize. I think from a risk perspective, and you think about the corporate response and the continuous evolution around the way companies are navigating these unprecedented times, companies continue to make bold assertions, bold commitments, bold ambitious targets, which is so inspiring to see. And I think, again, in the spirit of this rapid acceleration from a sustainable finance standpoint, that there's a new level of accountability to companies who are making these really bold and ambitious assertions to the market. And again, this is where the importance of high quality and standardized disclosure that is reliable comes into the discussion in terms of the performance that capital markets participants are looking to hold companies accountable to, and really the role that standards And then as a result, the emphasis within organizations around putting an effective governance structure and control environment around the issues, continuously prioritizing to manage issues effectively, and establishing very clear and consistent reporting protocols and mechanisms, and how that sort of rigor and discipline that's applied generally to financial reporting can also be applied to ESG disclosures to really instill that investor grade confidence in disclosures. You know, I think we've seen even over the last couple of months, the momentum continue to grow. I think we saw somewhat of a pause in terms of the pandemic, and then clearly the continual societal compounding concerns that we see companies navigating. But we've seen just over the last even just couple of weeks and months where from a policy and regulatory standpoint, clearly the EU in particular is moving rapidly in terms of really advancing ESG climate considerations. Even in the U.S., where we generally, just understand that this whole agenda is not driven out of Washington, not going to be anytime soon, and soon is a relative term, I think, as we can all appreciate. But we did see that the SEC's Investor Advisory Committee put out a very clear recommendation to the commission that, if you continue to sit on the sidelines and you're not actively engaged in this discussion, this is all going to take shape out of Europe or elsewhere, and U.S. companies are going to be having to navigate somewhat uncharted territory in terms of how they continue to deliver from a competitive landscape, high quality, meaningful ESG information. We saw just a couple of weeks ago, the Regulation SK modernization rules were finalized. So the first time the SEC has an ESG disclosure requirement. This is not just guidance, but a particular emphasis on the importance of human capital and a clear disclosure requirement, very principles based, but definitely a signal to U.S. companies, and it's elevating the conversation within organizations. I think on the broader standards landscape, ESG standards landscape, I know many of you are likely following many of the developments just starting a couple of weeks ago, where we saw the joint statement by the 5 large ESG standard setters and frameworks committing to work together along with IFAC in terms of really working towards a more authoritative market infrastructure to really help drive clarity and reduce that uncertainty and fragmentation, if you will. Fast forward a couple of weeks, we saw the launch just 2 weeks ago of the World Economic Forum International Business Council the recommendations out of the WEF-IBC as a proposed catalytic, collective action framework that really is intended to serve as that voice of business to engage in this conversation towards rationalization of ESG standards, with a particular emphasis and clearly a lead with that information to be useful to investors in particular needs to be easily accessible by investors, and therefore there's a very clear emphasis on the avenue for disclosure, and needs to be relevant to the overall enterprise value and corporate performance of the organization. And that suggests that these ESG issues that are material to the organization should be included in more mainstream filings. Now, I think there's a little bit of some of the headlines almost suggested a little bit of objective that was counter to the true objective of the IBC report, where the largest firms, my firm included, helped to facilitate the conversation and what ended up to be the ultimate recommendations as very clearly a tool, again, a collective action framework to really motivate and mobilize, as well as catalyze action towards a consistent set of disclosures to be included to the capital markets. There's clearly a recognition that materiality is the name of the game, and business judgment is the clear obligation of corporates. And so there's certainly a comply or explain, disclose or explain set of considerations, but it's a really notable development in the market in terms of the voice of business playing an important role in this rapid move towards rationalization of the standard setters. And then fast forward just last week, we saw the IFRS Foundation issue its consultation about creating an authoritative non-financial standard setter, a sustainability standards board, as well as the IAASB, which is the international body that governs audit standards. publishing a practice alert to provide details on the role that auditors in the financial statement audit context need to be considering in terms of delivering and understanding climate risk as it relates to not only just all the broader universe of disclosures that companies are providing, but as it relates to the financial reporting. So again, this is all moving very quickly and very rapidly as we look to close out this calendar year. And I think just a few takeaways for all on the line and sort of just the broader community that, you know, the importance of standards is clear. The information efficiency that can be promoted through standards is critical. We all recognize that standards can't solve for every opportunity or risk that an organization has, but it helps to drive that efficient access to and transparency effectively. In order to be decision useful, this information in terms of the ESG disclosures that are provided, regardless of the avenue for disclosure, if it's in a standalone report, if it's increasingly included in more mainstream filings, needs to be of high quality. And that requires an effective governance structure, a clear control environment where you have a process in place that has sufficient rigor and understanding, prioritizing, navigating, and developing responses to risks and opportunities from an ESG perspective, and then ultimately providing this information in a timely manner, in a manner that provides not only confidence by the board of directors and senior leadership that the information is accurate and complete, but it instills that trust with the external market participants who are relying on it. And the role that external assurance can play is an increasing part of the discussion when you think about an effective governance structure and how critical monitoring and assurance is a part of any governance structure. So again, a lot of emphasis on the evolution, the rapid evolution towards rationalization of standards, which will enable more efficient disclosure to the market. So I'll pause there, and I don't know if we have a few minutes for questions.
Yes, Kristen, we do. And the first question for you is, someone is concerned about the multiple choices regarding standardizing metrics and is wondering if the comparison between industries and companies has gotten too complex and is a barrier to moving forward in a more accelerated way, as Peter suggests we need to do. Do you have a response to that?
Yeah, I think there's certainly been this common refrain, this fatigue in the market in terms of the disclosure landscape and the whole multitude of players, both standards as well as the data providers that continue to become much more influential in encouraging and motivating corporate behavior from a disclosure standpoint. I think that just puts the emphasis on the importance of the developments that I just explained. The World Economic Forum IBC report is intended to define 21 core metrics and 34 expanded metrics that draw on existing standards to really demonstrate how companies can look to, in a consistent fashion, look to recognize standards in an efficient and a very focused manner. And this is all a step in the mobilization towards a more comprehensive corporate reporting scenario where, again, the IFRS Foundation has a consultation to create a sustainability standards board that would create that due process, governance, and authoritative nature of ESG disclosure that would somewhat remove the latitude, if you will. Now, it's not going to completely, as I mentioned before, business judgment is really the name of the game. And so companies really need to determine how to most effectively communicate with their critical stakeholders. But we are seeing this movement to rationalize and drive more clarity so it reduces the fatigue that I think this participant is touching on.
Okay. Peter, did you have any other questions for Kristen? I don't know if Peter's on mute, but okay. Well, Kristen, thank you so much for your presentation today, and we'll look forward to speaking to you again soon.
Thank you.